Welcome to our discussions on accounting, and this is a series on understanding and introduction to financial accounting, and we are going to start with a basic understanding of what is accounting and how the accounting captures the business transaction. But I would like to inform that it's better to use a headphone for audio clarity. We are defining accounting not as a process of recording the transaction, but we are defining accounting as a process of converting the business decisions into financial statements. So accounting is a process of converting the business decisions into financial statements. What are these business decisions? A business can take several decisions, but all the decisions can be classified into three broad categories. One is called financing decisions, investment decisions, and operating decisions. So any decision that a business takes can be classified into these three broad categories. So identify, understand the business decision and classify them. As we move along today, we'll see what are these decisions with example. And all these financial decisions, all these business decisions will have financial items like capital, salary, cash, name it, a number of financial items. But for recording purposes, the accounting conceptual framework classifies these financial items into 5 categories. One is called incomes, expenses, assets, liabilities, and equity. In other words, all the business decisions will involve financial items, and all these financial items can be classified into incomes, expenses, assets, liabilities, and equity. And this is the fundamental relationship between business decisions and financial items. And we are saying that all these financial items will appear in financial statements, that is the balance sheet, income statement, and the cash flow statement. That means, so every business decision, whether it is FD or ID or OD, will involve one of these items, and these items will find place in either balance sheet or an income statement or the cash flow statement. And this process of capturing the business decisions into financial statement is called financial accounting. The balance sheet will show the assets, liabilities, and equity. Balance sheet will show the assets, liabilities, and equity. The income statement will show incomes and expenses. Incomes and expenses, and the cash flow will show the receipts and payments. So therefore, all these business decisions will find a place in the balance sheet, income statement, and cash flow statement in the form of financial items. So to recap, I'm saying that business decisions, the process of converting business decisions into financial statement is the financial accounting. So the process of converting business decisions into the process of, I might have mentioned sometime, process of converting the business decisions into financial statements is what we are defining. Statements is financial accounting. Okay, financial accounting. So that is the understanding of accounting for the time being. But as we move along, we will see how does this happen, and what is the process of converting these business decisions into the financial statements. So let us go to the next one. I have taken an example. So financing decision. Suppose I'm starting business with capital is a financing decision. I've taken a loan is a financing decision. So decision to start a business with capital is financing decision. And what are the related financial item is a cash and capital, and they will affect the cash flow statement and the balance sheet. When I'm availing loan is again a financing decision. So items involved are cash and loan, and the financial statements where they will find place is the cash flow and the balance sheet. Suppose I take an investment decision, purchased plant. So the financial items are plant and the cash, and they will find place in the balance sheet and balance sheet. If I take some operating decisions like purchase stock on credit or for cash, these are all operating decision. The corresponding items are goods, cash, or stock, or the creditor, because you are purchasing on credit, and they'll find place in the balance sheet and income statement, or balance sheet and a cash flow statement. So similarly, if I'm paying salary is another example of operating decision. So it's an expense and cash are the financial item, and they'll find place in the income statement and a cash flow statement. Financing decisions, another example is the interest paid. There's no end to the list can go on. So this is to demonstrate that every business decisions that you take will involve the financial item, will affect one or two or all the financial statement. Now let us take an example, numerical example, to explain that. I'm saying that these are the financial transactions, and I'm saying that this financial transaction will find a place in the balance sheet, income statement, cash flow in the form of financial items. So as I mentioned, the sources may be equity or the liability. The assets are land, building, plant, machinery. Their incomes, expenses, receipts and payment. Let me remove this for the time being. Let us put some number. Let's say 5,000 I'm starting business with. When I'm starting business with 5,000 is not an income, but it is a receipt, and the receipt name is called capital. I'll show the capital as 5,000. And the corresponding source of that money is 5,000. Don't worry for the process now. As we move along, you will going to develop that process thoroughly. Now I'm taking another loan of 2,000. So therefore, once again there is a receipt. So I've taken a loan, and therefore 2,000 is not an income but is another source. So therefore 2,000 will come here. I'm purchasing stock. Let's say I'm purchasing stock for 3,000. Okay, I'm purchasing stock, so that means I'm getting an asset which is called stock. Okay, and that is 3,000, and for that I paid money. And for what? I paid money for the purchase of stock. You can see that every item will find a place in some or all of these. Now I'm selling this entire stock. Let's say I'm selling this entire stock for 9,000. So this is the first time I'm getting sales, which is an income, and this is for cash. So I'm going to get the sales in the form of cash, so that is a receipt. But whenever there is a sale, the goods will no more be there. So therefore the goods will become an expense, which I am calling as a cost of goods sold. Cost of goods sold, and that is how much we are selling? The entire stock. So entire stock is gone. So what will happen to the stock? the stock will no more be there on the balance sheet. So okay, so we had a stock. If you see this, we had stock of 3000, we sold the entire stock, so therefore there is no more stock available. We'll see the implications and the process a bit more detailedly later. Then I paid salary. Suppose I'm paying 1000 salary. So once again there is an item called salary. I'm paying that salary and it's an expense, so therefore I have to show that as an expense. Okay, and in the same way, if I'm paying about 200 interest, so there is a payment of interest, okay, 200, and interest is an expense, okay, interest is an expense, 200. So every item has been transferred. After this, what we want to find out? Profit. We say that the summation of all these items, all the expenses, okay, so 4200, and the profit is 4800. So profit is, what will happen to this profit? Profit will become a source. Later on we'll see why it is a source. And what happened to my cash? The cash is receipts during the period 16,000. The payments during the period is 4,200. So cash in hand is 11,800. So cash in hand is an asset, and cash in hand is an asset. Okay, so you see, and as a result, your balance sheet, income statement, cash flow statement will show all these items. But this process, as I said, my focus is not this financial statement now. The example is to demonstrate this. Demonstrate that every decision you take will find place in the financial statement in the form of financial items, okay, in the form of financial item. So this process, what process? The process of, okay, so the process of what? Of converting the financial decisions into the balance sheet, income statement, cash flow can be explained through using, okay, one of the following methods. That means I can explain this process. I've not yet explained. I've just said that this is financial statements. I've just said that the process is called financial accounting, but I've not explained how this is happening. This process can be explained through the rules of, okay, the rules of debit and credit, okay, credit, or the framework of accounting equation. Okay, so I repeat, I'm saying that this entire process of converting the business transactions into financial statements can be explained through the rules of debits and credits, or the rules of the framework of accounting equation. But throughout my presentation, I'm going to use the framework of accounting equation to explain the process of converting the business decisions into the financial statement. So let me summarize. I've said that accounting is a process of converting the business decisions into financial statement, and now then I said this process can be explained to financial accounting equation, though I can explain through other. Most of the accounting books you'll see this, but in my sessions, in this presentation, we are not using the concept of the debits and credits. We are going to understand accounting through the accounting equation. So therefore, the next presentation will be on accounting equation. Thank you very much.